Good morning, everyone. Welcome to the class of Introduction to Finance. Today, let's start Chapter 6, Interest Rates. In Chapter 6, we have 4 sectors. Sector 1 is the cost of money and interest rate levels. So in this sector, we're going to give you an example, and based on the example, I'll try to explain to you the meaning of interest rates and its potential factors. In Sector 2, we discussed the determinants of interest rates. So that's actually based on what we discussed in Sector 1, but in Sector 2, we're going to formalize it using an equation or formula so that you know how to calculate the interest rates. If I give you the other determinants. In Sector 3, we are going to discuss the term structure and yield curves. So in this sector, we're going to use graphs to describe the relationship between maturity and interest rates. And the last sector is using yield curves to estimate future interest rates based on the pure expectation theory. So Sector 6 is not very, doesn't have lots of material, but all the 4 sectors, maybe except for Sector 1, all the other 3 are kind of important. The most important ones are the second one and the last one, but I will show you and I will highlight the important parts for you to better understand this chapter. So there are 3 learning goals in this chapter. First one is to list the various factors that influence the cost of money. So this is related to Sector 1. Learning goal 2 is to discuss how market interest rates are affected by borrowers' needs for capital, expected inflation, different securities risks, and securities liquidity. So here it has listed like 4 factors or determinants of interest rates. Actually, this is based on the learning goal 1 because all these 4 are factors that could influence the cost of money. Interest rates basically represent the cost of money, right? So in the learning goal 2, all those 4 factors are actually related to, but it's just in Sector 2 we're going to discuss how to calculate it, while in the learning goal 1 it's just a discussion. Or Sector 1 is more about learning goal 1 is more about qualitative discussion, while learning goal 2 is about quantitative calculation. And learning goal 3 is to explain what the yield curve is, what determines its shape, and how you can use the yield curve to help forecast future interest rates. So this is about this is related to Sector 3 and 4. But what is most important is you understand the meaning of yield curve under Sector 3, and you know how to calculate future interest rates based on what we learn from Sector 4, the pure expectation theory. So this is the learning goals for this chapter. Now let's discuss the meaning of interest rates or the cost of money. What are the potential factors that could influence or affect the level of interest rates? Here we listed 4. The first one is production opportunities. The second one is time preferences for consumption. The third one is risk, and the fourth one is expected inflation. So here you don't have to memorize it. I'll give you an example and explain to you how these ones are, why these ones are the factors, the 4 factors that could influence the interest rate levels. The example is based on an isolated island community where people live on fish. So a stock of fishing gear allows to survive, but they would like to have more fish. People on the island, the isolated island, they have a stock of fishing gears that allows them to survive, but of course they want to eat better, so they would like to have more fish. Suppose one of the island's inhabitants, A, had a bright idea for a new type of fish net that would enable him to double his daily catch. Yeah, so he was thinking of innovation. However, it would take him a year to perfect the design, build the net, and learn to use it efficiently. He cannot fish during that period. Yeah, it's costly to invest in innovation. It doesn't come free. So he has to invest in money, and he has to invest in time, right? In this island where people just live on fish, there's no money, there's no we're not talking about currency. So in this case, he has to invest in his time and energy. Therefore, he can't fish during that period. Then what? Then that's not possible, right? Because he has to eat to survive. Therefore, he suggests to other inhabitants B, C, D that if they could give him a fish each day for a year, that way he would have three fish every day, right? That is enough for him to survive. Then he would return 2 fish a day the next year. Yeah, so this is like 100% rate of return. If you give me 1 fish every day for a year, next year I'll give you 2 fish every day for a whole year. So in this case, BCD's fish in the first year are savings or investments, right? They put in this, they give A this fish so that they will get more fish, like twice more fish. They give him 1 fish every day this year, and then next year they'll get 2 fish every day. So their fish in the first year are what we call savings or investments, and the reward they get in the second year are return on the investment, right? And the more productive the new fish net would be, the more A could afford to offer his investors, right? If his fish net is like 10 times more efficient, in that case, if now he can fish like 3 fish every day to survive, next year he's going to fish like 30 fish every day. So even if after paying back his investors like BCD, in total he has to pay them 6 fish every day, right? He still has 14 fish left. So in this case, he could actually offer more to attract BCD to invest in his project, right? So productivity is an important factor. And how attractive A's offer appeared to a potential saver would also depend in a large part on the saver's time preference for consumption. What does it mean? It means that let's say if B is a young man who doesn't have a family, right? A single man, then in this case he doesn't have how to say obligations to feed others. So and he's strong, he's young, so therefore if he can like get 10 fish every day, and giving A 1 fish every day is really nothing for him. So in this case, A's offer probably is very attractive to B. But if C is let's say a family man who is a father of 4 kids plus a wife, so in this case he has to fish at least, each of them has to have 3 fish to survive every day, and in total that's a 6 person's household. So he has to fish at least 18 fish every day for the family to survive. Then in this case, if he fish 10 fish every day, his family is going to starve, right? So he has to at least fish 20 fish every day for the family to survive. Then in the end, he only has 2 fish left, and you want him to give A 1 fish. In this case, his budget is quite tight, right? So he would definitely think about it carefully. He wouldn't just invest easily like B. And let's say if D is an old man who is already like in his 80s, that he can barely fish like 3 fish every day. So he's just barely surviving. In this case, he also would be very reluctant to invest, right? Because he can barely feed himself, and 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 even if you offer him 2 fish every day next year, he's probably thinking, I don't know whether I will be able to live until next year, right? So in this case, these BCD, they all have different time preference for consumption, right? And that could affect their willingness to invest in A's project, right? And the last factor, or the third factor, is risk. The risk inherent in the fishnet project also affects the return that investors acquire. What does that mean? We don't know much about the fishing, but we could say that just depending on how credit-worthy A is. If he's a very reliable man, he always keeps his words, then people are probably more willing to invest in his project. They believe in him. They believe that he promised 2 fish next year, he will do it. But if he's never reliable, he never keep his words. Yes, he promised me 2 fish every day for the next year. I don't believe in him. He can easily just disappear, or even if it doesn't disappear, he just refused to pay back my fish. So in this case, his offer will be less attractive, right? So here we have discussed 3 factors: productivity, time preference, the risk, and the last one, if you remember from the previous slide, is inflation. We can go back and see. Yeah, so the last one is inflation. But inflation is something related with currency. And in this example of an isolated island where they don't use currency, there's basically no inflation. But we're going to discuss inflation later. Actually, it's the first important factor that we're going to discuss, or we have in the equation to calculate the interest rate levels. The 2 figures here describes how interest rates is a function of supply and demand for fund. So here you see 2 graphs. The one on the left is market L. So that's the market for low risk securities. The one on the right is market H. So this is the one for the high risk securities. And in each figure we see a demand and supply curve. Although in each figure we have 2 supply curve, while there's only 1 demand curve on each side. So you see that for the in market L, the low risk securities, the initial interest rate is 5%. It's here. It's the meeting point of demand curve and supply curve 1. So S1 and D meets at this point, indicates that the interest rate right now is 5%. And then the initial interest rate for market H is 8%. Oh, sorry, 7%. It's S1, right? So they meet at RH, which is 7%. That means if everything else is the same between these 2 securities, the high risk and the low risk securities, except for the risk, everything else is the same. The only difference between these 2 securities is the risk. Then in this case, the risk premium, so the extra risk, the risk premium is 2%. That's 7 minus 5. So means that investors deserve at least 2 extra percent interest rate for the extra risk they take. So right, so in this case, the 2% is the extra interest rate, is the risk premium. That's what we call. But let's assume that something exogenous suddenly happened. Let's say maybe it's natural disasters, yeah, flood, or I don't know, earthquake happened. Then people suddenly become very risk averse. So in this case, the supply curve has changed from in market L is from S1 to S2, meaning that the supply has increased. So people want to invest in low risk securities. While for market H, it's from S1 to S2, but it's moving inward, meaning that supply has reduced. So what does it mean? It means that after this exogenous shock of natural disasters, people prefer to invest their money in low risk securities meaning that they would withdraw money from the high risk security market and put it in the low risk securities market. So that means the interest rate for the low risk securities would would decrease to 4% because of the increase in supply, while the interest rate in the high risk securities market would increase to 8% from 7%, right? So right now, the new interest rate is going to be 4% in market L and 8% in market H. And remember, these two securities are still the same except for the risk level, right? So in this case, the risk premium between these two securities are going to be 8 minus 4, so 4%. So you see that when the market is risk averse, when people all want to flight to quality, they all want to invest in low risk securities. The supply for the low risk has increased, meaning that the interest rate for the low risk securities are going to decline, while the supply for the high risk securities are going to are going to the supply are going to reduce, right? So in this case, and then in this case the interest rate goes up. So you see here is a clear example that why interest rate is a function of supply and demand for funds, because both supply and demand can affect the level of interest rates. So this basically is just explaining what we saw on the previous slides. The interest rate is initially 5% for the low risk securities in market L and 7% for the high risk securities in market H. In this scenario, investors are willing to accept the higher risk in market H in exchange for a risk premium of 2%, which equals to 7 minus 5. Assume that because of changing market forces, investors shift towards safer investments, referred to as flight to quality or safety. As investors move their money from market H to market L, risk premium rises from 2% to 4%, and this 4% is the difference between the 8% and the 4%. Yeah, so basically that was the sector 1, the cost of money. We have explained that those are the factors that could affect they could influence the cost of money, basically the interest rate levels. Next is sector 2, determinants of interest rate. So in this sector, we're going to use some equation to quantitatively calculate the appropriate interest rate levels. So this is the equation. You see I've highlighted it, means that it's very, very important. This is basically, if you can understand this equation very well, this formula very well, then basically I'm sure you can answer 80% of the questions in this chapter, including both all the questions in the quizzes and homework as well. So let's have a look at all the variables in this equation. On the left hand side, it's R. This is the required rate on the debt security. Yeah, this is the required rate of return, R. R star is the real risk-free rate of interest. Yeah, so that's R star. That's why it's called real risk-free of interest rate, because it doesn't consider the effect of inflation. The third factor here, or the second determinant here, is the inflation IP. Here I'm just showing you the name and the equation in general. I'm not going to discuss it in detail. That's what we're going to do after this slide. I'll explain to you one by one what those premiums mean, and later we'll discuss how to calculate them. So the third determinant is DRP. This is default risk premium. Yeah. And then the second last premium is liquidity premium. And then the last one is MRP, maturity risk premium. Okay, so now let's discuss them one by one. Let's start from R star and R. So R on the left hand side is the nominal interest rate, R represents any nominal rate. R star represents the real risk-free rate of return or rate of interest. Yeah, so this is real interest rate. What does real mean? Real means everything. Real means like the interest rate that do not consider the it considers the sorry. Real is the one that you exclude the effect of interest inflation. Or what does it mean? It means that you have to consider the effect of inflation. Yeah, so that's what real means. It's like a treasury bill rate. If there was no inflation, then typically ranges from 1 to 4% every year. So that's a real risk-free rate of interest. And then the third one is RF. What does RF mean? Means risk-free. So this represents the rate of interest on treasury securities, because all treasury securities are risk-free. Yeah, and then the last one is RF equal to R star plus the inflation premium. Yeah, so because R star doesn't consider the inflation premium, so R star plus the inflation premium would be equal to the risk-free interest rate, the RRF. Okay, next let's discuss the those premiums, those risk premiums one by one. After R star, which is the real risk-free of interest rate, the next one is IP, which represents the inflation risk premium. The inflation rate built into interest rate is the inflation rate expected in the future, not the rate experienced in the past. So that's the first thing we need to clarify when we discuss the inflation premium. That's the inflation expected in the future. Means that we actually don't really know how high the inflation is going to be, but this is what we predicted the inflation level in the future. Yeah, so it's the expected inflation rate, not the actual interest rate, inflation rate that we have already experienced. So actually that means if right now the inflation is quite high, then in the future we actually predict it's probably going to be a bit lower. At least over time it's going to go down. Yeah, if now it's quite low, then we predict that over time it actually might increase. So that's the first thing. It's the inflation in the future, not the inflation in the past. Second is that when we try to calculate the inflation rate expected in the future, how do we calculate it? Usually, the inflation rate reflected in the quoted interest rate on any security is the average inflation rate expected over the security's life. Yeah, so two things you can capture from this sentence. The first one is we use the average inflation rate. Next, we're going to discuss how to calculate average inflation rate. I keep saying interest. It's inflation. So first thing is average. Second thing is for how long. It's for the security's life. Yeah. So if it's a 3-year security, then we only consider the inflation in the next 3 years until it matures, right? Because after it matures, no matter how high the inflation rate is, it won't have an impact on the securities rate of return, right? Interest rate. So it's only the average inflation rate expected over the security's life will have an impact on the security's interest rate. Okay, now let's go back and discuss how to calculate the average inflation rate. We use the arithmetic versus the geometric averages when bringing inflation into interest rate determination in yield curve related problems, excluding the effect of cross product terms. Yeah, so means that actually geometric averages probably makes more sense, especially when you consider time value of money. But to make the calculations easier, simpler, we just use the arithmetic average. Yeah, just the simple average where you add up all the inflation rate for each year and then divided by the number of years. Yeah, so that's how you calculate inflation rate premium. But I'll give you an example later to show you how to calculate this inflation risk premium. The second premium is the default risk premium. It follows this rule that the greater the bond's risk of default, the higher the market rate, right? Because if the issuer has a relatively low credit ratings, means that it's relatively risky, then in this case, for him to convince the investors to buy his bond, he usually has to offer high interest rate, right? So that means the greater the risk of default, the higher the market rate. And the difference between the quoted interest rate on the T-bond and that on the corporate bond with similar maturity, liquidity, and other features is the default risk premium. It's what we call DRP. Yeah, so that's usually the difference. The difference between the corporate bond and the treasury bond, with everything else is the same, right? The similar maturity, liquidity, and other features, except that one is the treasury bond, one is the corporate bond. Then in this case, the difference between these two interest rates are going to be the default risk premium. Why is that? It's because treasury bond we consider it as like risk-free. It has no default risk. When we say risk-free, we mean default risk-free, right? Because it still has other type of risk, but no default risk. Yeah. So, and everything else is the same. The only difference is the default risk. Then in this case, the difference between these two type of bond is going to be what we call default risk premium. The average default risk premiums vary over time and tend to get larger when the economy is weaker and borrowers are more likely to have a hard time paying off their debt. So in that case, people prefer the the low risk securities, and then in this case they will ask for more compensation for every little risk they take. That means the default risk premium is going to be higher. Yeah. Liquidity risk premium is the third premium that we're going to discuss, because people in general prefer assets that are more liquid. So investors include a liquidity premium in the rates charged on different debt securities. So that's liquidity risk premium, LP. Yeah, because we all want a type of security that we can easily sell on the market and turn it into cash whenever we need, right? No matter how profitable that security is, no matter how much high rate of return you can potentially get from that security, if it's not liquid, if it's hard to sell, when you need money, you still don't want to hold too much of it, right? So then in this case, the liquidity for those assets that are more liquid, they can pay you relatively less interest rate of return because of this liquidity premium. And real assets are generally less liquid than financial assets, but different financial assets vary in their liquidity. Usually, the stocks of big companies are more liquid than the stocks of small companies, and usually stocks are more liquid than bond. Yeah, so different financial assets vary in their liquidity. And the liquidity of real assets also varies over time, right? When the housing market is booming, then it's relatively easy to sell a house. But if, like right now, the interest rate is very high, then it's relatively harder to sell the house. So even for real assets, liquidity is different, and it can vary over time. The fourth premium is the maturity risk premium. The prices of long-term bonds decline whenever interest rates rise, and because interest rates can and do occasionally rise, all long-term bonds, even treasury bonds, have an element of risk called interest rate risk. Yeah. So as a general rule, the bonds of any organization have more interest rate risk the longer the maturity of the bond. So therefore, the greater the years to maturity, the higher the maturity risk premium is. What does it mean? It means that if the bond has long maturity, then it's more likely to be affected by the change of interest rate, right? So in that case, there's that risk that the price of there's a bigger risk that the price of the bond are going to fluctuate with the change in the interest rate, and this brings a risk of a risk to the price of the bond, right? So that's maturity risk premium. The effect of maturity risk premium is to raise interest rates on long-term bonds relatively to those of short-term bonds, right? Because long-term bonds have bigger exposure to the maturity risks because they have longer maturities. Therefore, they are charged a higher rate of return to compensate for this uncertainty risk. Yeah. So this premium is difficult to measure, but first it varies somewhat over time. It's rising when interest rates are more volatile and uncertain, because maturity risk premium is essentially a type of uncertainty risk premium. And then this maturity risk premium would be falling when interest rates are more stable, because it's less uncertainty. And in recent years, the maturity risk premium on 20-year Treasury bond are generally being in the range of 1 or 2 percentage points. So it follows this equation. But this is like based on experience. It's not based on theory. That maturity risk premium is about 0.1% of the number of years of the maturity. This is based on experience, and it can be different for different types of security. So this equation is just an example, but usually when in questions, in quizzes, in homeworks, I'll give you an example of the maturity risk premium. So do not always assume that maturity risk premium has this relationship with the number of years in the maturity. This is just an example. So this slide is very, very, very important. If the equation I showed you before like counts about 80% of the questions in this chapter, then this slide alone would count, I would say, at least half of the questions in this chapter. But of course, there are overlaps. Yeah, so that equation is a general equation, and this slide shows you how to use that equation for different types of for calculations of interest rate for different types of securities. Yeah, so this slide shows you the premiums added to R star for different types of bond or debt. So there are 4 types of debt. They are differentiated along 2 dimensions: treasury versus corporate bonds, short-term versus long-term. So therefore we have 4 different types of bond: short-term treasury bond, long-term treasury bond, short-term corporate bond, and long-term corporate bond. And these 4 columns represent 4 different types of premiums: inflation premium, market risk premium, default risk premium, and liquidity premium. So you can see for treasuries, they don't have default risk premium. Neither do they have liquidity premium, because first, they are default risk free. The federal government will never default, will never collapse, therefore they won't default. So there is no default risk premium. You don't have to compensate for the investors for the risk of default, because there's no risk of default. And then second, there's no liquidity premium, because the treasury securities has basically the most active secondary market in this world. There are huge demand and supply in the market, therefore it's always very liquid. Therefore, for treasuries, you see, you don't have to consider default risk premium and liquidity premium. What does it mean? It means that if you use that equation to calculate for treasury securities, just assume these two always equal to 0. These two, default risk premium and liquidity premium, always assume these two equal to 0. Yeah, so that's for treasuries. And for corporate, these two are always there. Yeah, and then the other differentiation is between short-term and long-term. Remember, maturity risk premium that we just discussed. We say the longer the maturity, the bigger the maturity risk premium. So for short-term bond, no matter whether it's short-term treasury or short-term corporate, because they are usually short-term. When we say short-term, we mean maturities within 1 year. right? If maturities is within 1 year, then usually interest rate won't change too much over that year, because it's just 12 months, right? And then each time the Fed meets like 8 times for a whole year, and it's not that every time they will change the interest rate. So in overall, interest rate won't change too much over 1 year, and then therefore it's relatively less uncertainty risk about the change of the interest rate within that year. Therefore, maturity risk premium is almost zero for short-term treasuries and short-term corporate bond. So just for short-term maturities, we assume maturity risk premium is always zero. Yeah. And then for inflation premium, everybody has it. No matter whether you are short-term or long-term, no matter whether you are treasury or corporate bond, everybody has to pay or consider this inflation premium. So this is very important, because when we give you a question or a calculation in a quiz or in the homework, we won't show you this one. We'll just tell you what type of security that is. For example, I tell you it's a short-term treasury bond. Then in this case, you have to assume, you have to like know that if it's short-term treasury bond, then I don't have to add maturity risk premium, default risk premium, and liquidity premium. Basically, these three are all equal to zero. All I need to know in this case is the inflation premium and real risk-free rate of interest, right? As long as I know those two, I can calculate the required rate of return for this short-term treasury. Yeah, so therefore, this slide is very, very important. Okay, so the next part is the yield curve and the term structure of the interest rates. I won't finish this part, but I want to explain a little bit here. What does yield curve and term structure means? So let's first discuss term structure. Term structure means represent the relationship between the interest rates and maturities. Yeah, so usually the vertical line represents the maturity, and the horizontal line represents the interest rates or the yields. And in general, or the normal relationship is the standard relationship is the a rising relationship. That means the longer the maturity, the higher the interest rate or the higher the yields. Yeah, and yield curve is basically just a graphic a graphic expression of the term structure. Yeah, so term structure represents the relationship between the maturity and interest rate, and yield curve is just draw a curve that shows you this relationship. So the yield curve is a graph of the term structure. That's that's the relationship between these two. So you can see in the graph here, this is the yield curve for March 2015, and you can see it's upward rising, right? So the longer the maturity, the higher the interest rate. If it's short term, then it's relatively low. If it's intermediate term, it's in the middle. If it's long term, then it's the highest interest rate, right? So, and there are usually three types of interest rate or yield curves: upward sloping, downward sloping, and hump shape. Yeah. So the green curve is the yield curve for May 2018. This is the upward sloping yield curve. This is called the normal yield curve. The blue one is the downward sloping yield curve, and this one is the yield curve for March 2080, around 2080. So this is downward. This is abnormal. Yeah, this is an inverted yield curve, and this is considered as abnormal. Upward is normal. Downward is abnormal. And why is that? It's, remember we said before, one premium that is closely related with the maturity is the maturity risk premium, right? And the based on the statistics, based on the experience that we have seen, is that the longer the maturity, the higher the maturity risk premium, right? Therefore, in general or in normal days, the longer the maturity, the higher the interest rate because of this maturity risk premium. So that's why the green one is the norm, is the normal yield curve. But why would the blue one be downward sloping? Why is that? It's because apart from the maturity risk premium, there are other premiums, right? So the other thing that could change with the maturity is the inflation expectation, right? So if right now the inflation is very high and we expect the inflation is going to go down in the future, at least in the next number of years, then in this case, the inflation premium is going to be lower in the future, and therefore that could bring down the interest rate levels, even if the maturity risk premium is positive for long-term maturities. But if the inflation premium is relatively or much lower, it can still make the required rate of return, the interest rate, be lower for long-term maturities. Yeah, and then the middle one is the orange one, that is the hump-shaped. So that is if interest rate on intermediate term maturities were higher than the rates on both short-term and long-term maturities, then it is called hump-shaped yield curve. What does it mean? Means that the interest rate for both short-term and long-term are lower than the interest rate for the intermediate term. Most likely it's because the inflation for the intermediate term is going to be the highest. So inflation is expected to continue rise for the next number of years in the near future, and then it's going to go down in the long future. That's why you observe this this peak in the intermediate term because of the rise in the inflation for that period. So here are some exercise questions. The first one, the yield curve shows the relationship between bonds maturities and their yields. True or false? So that's the relationship between maturities and yields. The correct answer is true, right? That's basically the meaning of term structure, and yield curve is just a graph of the term structure. The second one, since yield curves are based on real risk-free rate plus the expected rate of inflation, at any given time there can be only one yield curve, and it applies to both corporate and treasury securities. True or false? Yeah. This part is true, but the yield curve are based on the real risk-free rate plus the expected rate of return, plus there are some other premiums, including default risk premium, liquidity premium, and maturity risk premium, right? So therefore, there are still other variations, and therefore, it's not just one yield curve that applies to both securities. There are many yield curves for different types of securities. So this one is false. Okay, so I'll stop it here and I'll leave the rest for the next class.